Most beginner traders don't fail because they're stupid. They fail because nobody teaches them the truth about trading. Social media makes trading look easy. You see people posting profits, luxury lifestyles, fast money, and winning trades. But what you don't see are the blown accounts, the emotional breakdowns, the revenge trading, and the months of frustration behind the scenes. The reality is, trading is one of the hardest skills to master psychologically. And almost every beginner makes the same painful mistakes before becoming profitable. So in this video, we're going to break down the 10 biggest beginner trading mistakes that silently destroy accounts. If you can avoid even a few of these mistakes early, you'll already be ahead of most traders. Let's start with mistake number 1. Mistake number 1. Trading without a strategy. This is where almost everybody begins. A beginner opens TradingView, watches a few TikToks or YouTube shorts, learns one random pattern, and immediately starts risking real money. No backtesting, no rules, no system, just emotions and hope. That's not trading. That's gambling. Professional traders don't take random entries. They follow a repeatable process. A strategy gives you structure. It tells you when to enter, when to exit, where your stop loss goes, and how much risk to take. Without a strategy, every trade feels emotional. And emotional traders lose money. Before risking real money, you should know exactly why you're entering a trade. Mistake number 2. Risking too much per trade. This one destroys accounts fast. Beginners think, if I risk more, I make more. So they risk 20%, 30%, sometimes even their entire account on one trade. And when the trade loses, their confidence disappears instantly. Here's the truth. Professional traders focus more on protecting capital than making money. Because if you lose your capital, you can't trade anymore. Even the best traders in the world lose trades constantly. The difference is, they keep losses small. Most experienced traders risk only 1% or less per trade. Why? Because trading is probabilities, not certainty. You can have the perfect setup and still lose. Risk management is what keeps you alive long enough to become profitable. Mistake number 3. Overtrading. This is one of the most addictive mistakes. Beginners think more trades equals more money. So they trade every tiny movement, every candle, every breakout, every random setup. But the market doesn't pay you for being active. It pays you for being patient. Sometimes the best trade is no trade at all. Overtrading usually comes from boredom, greed, or the need to make back losses. And that mindset becomes dangerous very quickly. The best traders are selective. They wait for high-quality setups. They let the market come to them. Trading less often usually improves results. Mistake number 4. Revenge trading. This is where emotions completely take over. You lose a trade. You get frustrated. And instead of calming down, you immediately enter another trade to recover the loss. Then you lose again. Now you're angry. You increase lot size. You stop following rules. And suddenly your account is collapsing. Revenge trading is emotional trading. The market doesn't care about your last loss. It doesn't owe you money back. One of the biggest skills in trading is learning how to stay emotionally neutral. Losses are normal. Even profitable traders lose many trades. The goal is not to avoid losses completely. The goal is to manage them properly. Mistake number 5. Ignoring psychology. Most beginners think trading is only technical analysis, indicators, patterns, support and resistance. But trading is mostly psychology. Fear and greed control beginner traders constantly. Fear makes people close winning trades too early. Greed makes people hold losing trades too long. And emotions destroy consistency. You can have the best strategy in the world, but if you panic every time price moves against you, you'll still lose. This is why trading psychology matters so much. Discipline matters more than intelligence in trading. The market rewards emotional control. Mistake number 6. Using too many indicators. This is a classic beginner problem. Your chart starts looking like a spaceship dashboard. See, mucked, Bollinger Bands, moving averages everywhere, and suddenly you can't even read price anymore. Beginners often believe more indicators means better accuracy. Usually it does the opposite. Too many indicators create confusion and hesitation. Price action should always come first. The market leaves clues directly on the chart. Structure, momentum, liquidity, support and resistance, trend behavior. Simple charts are often better. Most profitable traders eventually simplify their systems because clarity creates confidence. Mistake number 7. Not using stop losses. This mistake can destroy months of progress in one trade. Beginners often move stop losses further away or remove them completely. They hope the market will come back. Sometimes it does, but eventually one trade wipes out everything. A stop loss is not your enemy. It's protection. Professional traders accept small losses quickly. Beginners hold losing trades emotionally, and small losses become disasters. If your setup is invalidated, get out. Protecting your downside is part of the game. Mistake number 8. Expecting fast money. This is probably the biggest illusion in trading. Social media created unrealistic expectations. People think they can turn $100 into millions in a few months. Possible. Maybe. Realistic. Not at all. Trading is a long-term skill, like learning a profession. Doctors train for years. Athletes train for years. Pilots train for years. But beginners expect instant success in trading after watching 3 videos. Real profitability usually takes time, screen experience, mistakes, journaling, and emotional development. The traders who survive are the ones who focus on consistency instead of getting rich quickly. Slow growth is still growth. Mistake number 9. Not journaling trades. Most beginners never review their mistakes. They just trade randomly every day without tracking anything. But if you don't review your trades, you never improve. A trading journal helps you identify bad habits, emotional decisions, strong setups, and recurring mistakes. You start noticing patterns in your behavior. Maybe you lose most trades during certain market conditions. Maybe you perform better during trends. Maybe you break rules after losses. A journal exposes the truth, and truth creates improvement. Professional traders treat trading like a business. Businesses track data. So should traders. And finally, mistake number 10. Quitting too early. This is the mistake almost nobody talks about. Most traders quit right before they begin improving. The beginning of trading is frustrating for everyone. You lose money. You doubt yourself. You feel overwhelmed. But every profitable trader once felt the exact same way. The difference is, they kept learning. Trading is not about being perfect. It's about improving gradually over time. One lesson, one mistake, 1 month at a time. If you stay disciplined, protect your capital, and continue learning, you already have a chance. Because most people quit. And that's exactly why consistency becomes an advantage. At the end of the day, trading is not a shortcut to easy money. It's a skill, a psychological game, a test of patience, discipline, and emotional control. The market rewards people who survive long enough to learn. So avoid these beginner mistakes early, focus on risk management, stay patient, and think long-term. Because in trading, survival comes first. Profits come later. If you enjoyed this video, subscribe for more trading psychology, market structure, price action, and trading lessons for beginners. And remember, the goal is not to win every trade. The goal is to become a consistently profitable trader over time.